Ray Dalio stepped down from Bridgewater Associates in October 2021, handing over the keys to the world's largest hedge fund. The media celebrated his legacy. Financial textbooks praised his genius. But what if Ray Dalio didn't just predict financial crises? What if he helped create the very conditions that made his predictions inevitable? Here is what they do and tell you. Dalio's entire fortune was built on being right about markets. It was built on understanding that governments will always choose debt over defaults, that central banks will always print before they panic, and that the system rewards those who position themselves on the right side of the wealth transfer before the crisis even hits. You feel it every day. Your savings lose value. Your paycheck buys less. Housing costs explode while your wages stagnate. And somewhere, quietly, institutional money grows richer on the predictable chaos. Before we pull back the curtain, drop a comment and let me know where you're watching from. This channel delivers the unfiltered truth the financial media won't touch. Hit subscribe if you're ready to see how the game is really played. Because what you're about to learn will change how you see every market crash, every bailout, and every dollar in your account. Let's begin. Ray Dalio founded Bridgewater Associates in 1975 from his two-bedroom apartment in New York City. At the time, the global financial system was in chaos. The United States had just abandoned the gold standard in 1971. Inflation was out of control. Oil prices quadrupled after the OPEC embargo. The Bretton Woods system, the framework that stabilized currencies for 3 decades, had collapsed. This wasn't just economic turbulence. It was the death of hard money and the birth of a new era. Fiat currency, backed by nothing but government promises and central bank printing presses. Dalio saw what most economists missed. He understood that when governments abandon currency discipline, they don't just inflate prices, they transfer wealth. From savers to debtors, from the middle class to asset holders, from citizens to institutions. Sound familiar? Fast forward to today. Since the 2008 financial crisis, central banks have printed over $25 trillion in new money. The Federal Reserve's balance sheet exploded from under $1 trillion in 2007 to nearly $9 trillion by 2022. The European Central Bank, the Bank of Japan, the People's Bank of China, they all follow the same playbook. Inflate, stimulate, repeat. Meanwhile, housing prices in major cities have doubled or tripled. Stock markets hit record highs even as real wages stagnate. Billionaires added trillions to their net worth during a global pandemic, while 40 million Americans filed for unemployment. Sound familiar? Here's where Dalio's genius becomes dangerous. In 1982, he made a catastrophic prediction. He went on national television and warned that Latin American debt defaults would trigger a massive banking crisis and a U.S. depression. He was so confident, he bet the firm on it. He was wrong. The Federal Reserve and International Monetary Fund stepped in with bailouts and liquidity swaps. Banks didn't collapse. Instead, they restructured debt, extended timelines, and printed their way out of disaster. Dalio lost clients. He lost credibility. Bridgewater nearly went bankrupt. He had to lay off employees and borrow money from his own father to keep the firm alive. But here's the twist. That mistake became the foundation of his fortune. Dalio realized he had misunderstood the rules. The system doesn't collapse when debt becomes unpayable. The system adapts. Governments don't default, they devalue. Central banks don't tighten, they print. And those who understand the pattern don't fight it. They profit from it. So Dalio built a research machine. He studied every major debt crisis in history. The Weimar Republic, the Great Depression, the Latin American defaults of the 80s, Japan's lost decade. He codified patterns, he identified cycles, and he created the framework that would make him one of the wealthiest men on Wall Street, the long-term debt cycle. According to Dalio's model, economies move in predictable waves. First, credit expands. Borrowing is cheap. Asset prices rise. Everyone feels rich. Then debt becomes unsustainable. Defaults loom. Panic spreads. And finally, central banks step in not to fix the problem, but to delay the reckoning. They lower rates. They print money. They transfer the pain from institutions to citizens through inflation and currency debasement. Sound familiar? This is the mechanism. This is the engine. And once you see it, you can't unsee it. Dalio didn't just describe this cycle. He built Bridgewater's entire investment strategy around it. He positioned the fund to win when central banks acted predictably. When they cut rates, Bridgewater held bonds. When they printed money, Bridgewater bought gold and inflation-protected assets. When they devalued currencies, Bridgewater shorted the dollar and went long on commodities. The strategy was brilliantly simple. Bet on the inevitability of monetary intervention. By the early 2000s, Bridgewater managed over $100 billion. Pension funds, sovereign wealth funds, and central banks themselves became clients. The very institutions responsible for managing the debt cycle were paying Dalio to tell them how to profit from it. But here's the question no one asks. If Dalio's research is so valuable, why do central banks keep making the same mistakes? Why do governments keep choosing inflation over reform? Why does the cycle keep repeating? Because the cycle isn't a bug. It's a feature. In 2007, as global markets reached euphoric highs, Ray Dalio sent an internal memo to Bridgewater's team. The memo was titled, "The Coming Storm." In it, he outlined how subprime mortgage defaults would cascade into a global financial crisis. He predicted bank failures. He predicted government bailouts. He predicted massive central bank intervention. And he positioned Bridgewater accordingly. When Lehman Brothers collapsed in September 2008, global markets imploded. The S&P 500 dropped 37%. Trillions of dollars in wealth evaporated overnight. Retirement accounts were decimated. Jobs vanished. But Bridgewater's Pure Alpha Fund, it gained 14%. While the world burned, Dalio's fund made money. Not by luck, not by timing, by understanding that the crisis wasn't an accident, it was the predictable result of decades of debt accumulation, and the response would be just as predictable. Central banks would print, governments would bail out institutions, and the wealth transfer would accelerate. Here's where the story gets darker. In the years following the crisis, Bridgewater didn't just advise hedge fund investors. The firm began consulting directly with central banks and sovereign wealth funds. Dalio met with officials at the Federal Reserve, the European Central Bank, and the People's Bank of China. He shared his research. He explained his cycles. He provided the roadmap, and those institutions adopted his framework. But if central banks understand the cycle, if they know debt leads to crisis, and crisis leads to money printing, and money printing leads to wealth transfer, why do they keep doing it? Because the alternative is collapse, and collapse threatens the institution itself. This is the moral hazard at the heart of the system. Central banks can't allow defaults because defaults expose the illusion. They can't raise rates too high because debt becomes unserviceable. They can't stop printing because asset prices would crash, and the political backlash would be catastrophic. So they do the only thing they can. They kick the can. They extend the cycle. They make the next crisis bigger. And Ray Dalio built a $140 billion empire by betting they would never stop. You won't believe the name of the institution that became Bridgewater's largest client during this period. The receipt is wilder than you think. Let's break down exactly how this wealth transfer machine works. Because once you understand the mechanics, you'll see it everywhere. Step 1. The debt expansion phase. Governments and corporations borrow heavily when interest rates are low. This isn't optional, it's incentivized. Low rates make debt cheap. Politicians win elections by spending. CEOs boost stock prices with buybacks funded by borrowed money. Households take out mortgages, car loans, and credit cards. Between 2008 and 2020, global debt increased from $150 trillion to over $300 trillion. That's a 100% increase in just 12 years. Governments led the way. U.S. federal debt went from $10 trillion to $33 trillion. Japan's debt to GDP ratio exceeded 260%. China's total debt exploded from 100% of GDP to over 300%. This is the illusion of prosperity. Asset prices rise. Stock markets boom. Real estate becomes unaffordable. But the growth isn't real, it's borrowed from the future. Step 2. The debt becomes unsustainable. Eventually, debt service costs exceed the ability to pay. For households, this means defaults and foreclosures. For corporations, this means bankruptcy. For governments, this means a choice: default and destroy credibility, or devalue the currency and destroy purchasing power. They always choose devaluation. Here's why: debt is denominated in currency. If you owe $1 trillion and you control the printing press, you don't default, you print $1 trillion and pay it back with devalued money. Creditors get repaid in nominal terms, but the real value is destroyed through inflation. This is the parasitic mechanism. Savers are punished. Workers see wages stagnate while costs rise. But debtors, especially the largest debtors, governments and corporations, are rewarded. Their debt becomes easier to service as the currency loses value. Between 2000 and 2020, the U.S. dollar lost over 30% of its purchasing power. A gallon of milk that cost $3 in 2000 costs over $4.50 today. Housing, healthcare, and education costs have exploded even faster. But if you held asset stocks, real estate, commodities, you were protected. In fact, you profited. The S&P 500 increased over 300% during the same period. Real estate in major metro areas doubled or tripled. This is the wealth transfer, from those who hold currency to those who hold assets, from wage earners to asset owners, from the many to the few. Step 3. Bridgewater's positioning. Ray Dalio understood this mechanism better than almost anyone. His pure alpha strategy was designed to profit in any environment by balancing 4 economic conditions: growth, inflation, deflation, and stagflation. But the real genius wasn't diversification, it was understanding that central banks would always intervene to prevent deflation and defaults. So Bridgewater structured positions to win when intervention occurred. When the Federal Reserve cut rates to 0 in 2008, Bridgewater held long-duration bonds that surged in value. When the Fed launched quantitative easing, printing trillions to buy government and mortgage-backed securities, Bridgewater positioned in gold, which rose from $800 per ounce in 2008 to over $1,900 by 2011. When European central banks implemented negative interest rates, Bridgewater shorted European bonds and went long on U.S. assets. When China devalued the yuan in 2015, Bridgewater had already repositioned into dollar-denominated assets and commodities. Every move was a bet on predictable central bank behavior, and every bet paid off. By 2018, Bridgewater managed over $160 billion, making it the largest hedge fund in the world. Dalio's personal net worth exceeded $20 billion, and his research had become so influential that central banks and finance ministries around the world used his frameworks to guide policy. This is where the conspiracy becomes undeniable. Step 4. The institutional feedback loop. Here's the part that should terrify you. Bridgewater's largest clients aren't individual investors. They're pension funds, sovereign wealth funds, endowments, and central banks. These are the institutions managing trillions in public money, your retirement, your taxes, your national reserves. And they pay Bridgewater billions in fees to tell them how to navigate the debt cycle that those same institutions perpetuate. The New York Times reported in 2013 that Bridgewater had consulted with officials at the Federal Reserve, sharing research on debt dynamics and central bank policy. In 2016, Dalio met with officials at the People's Bank of China to discuss currency devaluation strategies. In 2019, Bridgewater opened a China fund specifically designed to capture flows from Chinese institutions as the yuan weakened. This is the feedback loop. Central banks create the debt cycle. Bridgewater profits by predicting the cycle, and central banks pay Bridgewater to advise them on managing the cycle they created. It's a closed system, and retail investors, the ones holding cash, the ones with fixed income pensions, the ones who don't own assets, are outside the loop. Step 5. The engineered dependency. By 2021, Bridgewater had become so embedded in institutional finance that its research was treated as gospel. The firm's daily economic reports reached hundreds of institutional clients. Dalio's principles outlined in his best-selling book, released in 2017, were taught in business schools and cited by policymakers. But here's the trap. If everyone believes the cycle is inevitable, everyone positions for central bank intervention, everyone expects currency debasement and asset inflation, then the cycle becomes self-fulfilling. Governments can't stop printing because institutions expect it. Central banks can't allow defaults because Bridgewater's clients are positioned for bailouts. Asset prices can't crash because trillions in institutional money are leveraged on the assumption that central banks will intervene. This is engineered dependency. The system now requires the cycle to continue. Any deviation, any attempt to tighten, to allow defaults, to restore currency discipline would trigger institutional collapse. And Ray Dalio built his empire by understanding this trap before anyone else. By the time he stepped down in October 2021, the machine was complete. Bridgewater managed $140 billion. The firm employed over 1,500 people, and the framework Dalio created had become the operating system for global institutional finance. Here is the truth they'll never tell you. Ray Dalio didn't just get rich by being smart. He got rich by understanding that the game is rigged, and the rigging is permanent. The debt supercycle isn't slowing down, it's accelerating. Global debt hit $307 trillion in 2023. Central banks are trapped. Rates can't stay high because debt service costs would explode. Rates can't go low because inflation would spiral. Governments can't stop spending because voters demand it. And the wealth transfer continues faster, more aggressive, more blatant than ever before. Dalio walked away at the perfect time. He handed over Bridgewater just as the system he mastered began showing cracks. Inflation reached 9% in 2022, the highest in 40 years. Bond markets crashed. Tech stocks collapsed. Regional banks failed in 2023, hiring emergency Fed intervention. And where is Ray Dalio now? Writing books, giving speeches, warning about the changing world order while sitting on billions made from the very system he describes. This is the moral hazard of borrowed time. The system survives by delaying consequences, but delay isn't prevention. The longer the cycle runs, the bigger the eventual reckoning. And when it comes, and it will come, the institutions will be bailed out, the currency will be debased, and you will pay the price. The pattern is always the same. In Weimar Germany, hyperinflation destroyed the middle class, while industrialists who owned factories stayed rich. In 2008, banks were bailed out while homeowners lost everything. In 2020, billionaires gained trillions while small businesses closed forever. The next crisis won't be different. It will just be faster, more global, and more devastating. So what do? You stop trusting the illusion. You stop believing that paper wealth is real wealth. You understand that currency is a tool of control, and those who control the printing press will always sacrifice your purchasing power to preserve their power. You position yourself like the institutions do. You hold real assets. You understand the cycle. You stop playing defense and start thinking like someone who knows the game is rigged. But most importantly, you stop pretending this is temporary. This is the system. This is the design. And Ray Dalio's $140 billion empire is proof that those who understand the design don't fight it, they profit from it. If this breakdown opened your eyes, share this video. Send it to someone who still thinks markets are fair, that hard work is rewarded, and that institutions serve the public good. Hit subscribe and turn on notifications because this channel exposes the mechanisms the financial media ignores. And drop a comment. Are we wiser now, or are we just walking the same path in better suits? The clock is ticking, the debt is growing, and the next transfer is already underway. The question is, which side will you be on?